Before starting the video, click the subscribe button and turn on the notification bell. Hello students, hope you all are doing well. So let us move to the issuance of shares. But before starting the video, let me tell you that you have to understand the basics of issuance of shares in part 1 video. So go and watch that as well and you'll understand better. So let us take a look on the video. So before moving towards the accounting of issuance of shares, we have to understand that how the company issues the shares. It can be by 3 modes. Number 1, it can be issued by the help of any bank, that the company may issue any sort of bank, and the bank may announce that it is selling the shares of any company, and the customer can approach the bank to buy the shares. Second, it can choose any of the brokerage house and sign a contract with it to sell its shares. Number third, the customer has an option to buy the shares online, and by online portal the shares can be sold to anyone. Subscription of shares, it is classified into 3 main categories: equal, over and under. Now what are that? Let's have a look. Equal subscription means when the company receives equal applications than the offered shares. Then number second, oversubscription, when the shares applications are received more than the offered shares. Number third, under subscription, when the shares are applied for less than the offered shares. So what happens in the accounting? Now let's have a look. Now let's take a look of equal subscription. Offered 5,000 shares at par. Now this offer can be made by bank, brokerage house or online. Then it received 5,000 shares applications and the company issued 5,000 shares against those applications. Now here we have to see one thing, that you cannot pass the entry of offered shares because the entry has to comply with the 3 rules. Number 1, occurrence, number 2, exchange, and number 3, monetary value. But in this statement of offered shares, we do not find exchange of anything, as the company is offering something and it has the monetary value, but it is not being exchanged with anything, so you cannot pass the entry. Then you'll pass the entry of received applications. So here we're receiving 5,000 shares applications. So what will happen? That the bank will collect the money of share application holders, and then the bank shall be debited as it is going into the company's bank account. Then shares application credit. Now you have to note one thing, that share application is a nominal account. It does not fall in any of the elements: assets, liabilities, expenses, revenue, owner's equity. Neither of the account it falls. So it is just a nominal account and it is opened until the shares are issued. So the entry shall be bank debit 5,000 into 10, 50,000, and share application credit by 50,000. Then issued 5,000 shares. So as we discussed, that share application is just a nominal account and it is opened until the company issues the shares. So now as the company has issued the shares, so share application shall be decreased or declined by debiting it. So share application shall be debited and share capital credit. Why? Because the company has issued the shares now and those application holders are shareholders now. So their amount shall be transferred to the capital account. So that is it. Oversubscription. Now we have a question that company offered 5,000 shares at rupees 15. the company received 6,000 applications and the company issued 5,000 shares. Why it is so? That why can't the company issue the number of shares if it receives more applications than the offered one? Because by law it is that company cannot issue more than the offered shares, as the company has to offer up to its capital. So therefore, according to the capital clause, company cannot issue more than the offered shares. So let's move towards the journal. On number 1, you don't have to pass the entry of offered shares. We have discussed it before that why it will not be so. Then you will pass the entry of received shares. So as we have received 6,000 share applications, so we shall debit the bank, as the money will go directly to the bank account of the company. So bank shall be debited by 6,000 into 15, 90,000, and share capital shall not be credited, but instead the share application shall be credited. We have discussed it before that share application is just a nominal account and it is open until the shares are not issued to the application holder. Then when you will issue the shares, the entry shall be share application debit by how much amount you have issued the shares. You have issued 5,000 shares at rupees 15. So share application shall be debited by 5,000 into 15, 75,000 only. Then now you have issued the shares to the shareholders. So they have become the shareholders and their amount shall be credited by share capital. And in part 1 we have discussed that share capital is credited by rupees 10 always. So 5,000 into 10 is 50,000. Then if the share is being issued at rupees 15, now 5 rupees shall be credited by share premium account. So 5,000 into 5 shall be in the share premium. So share premium credit by 25,000. You have to note one thing, that share premium account shall arise when the share capital account shall be arised and not with the share application account. Then if the company has to issue only the number of shares it has offered, so if it receives more application than that, so it will refund the excess applications. And what will be the entry of refund? Shares applications, when it were received, it were credited, and now it will be debit. And the bank account where the money was received and it was being debited, it shall be credited to reduce that bank account and to refund the money to the application holders. In short, we will reverse the first entry by the amount to the extent we have refunded the applications. So 1,000 applications were refunded and it were received at the price of 15. So 1,000 into 15, total 15,000 shall be debited and 15,000 shall be credited. So before moving towards the under subscription, you got to know this concept, that what is underwriting concept. Underwriting means an agreement signed between the bank and the company that if the offered shares will not be issued completely, the bank shall purchase the remaining amount of shares. Now let us move to the last one, under subscription, where shares are offered more than the received applications. Now we have offered 5,000 shares and received 4,000 share applications, then issued 4,000 shares at rupees 15, because you cannot issue more than the number of shares applications you have received. Then what will happen then? the bank will underwrite the remaining applications. Now, as we have discussed in both of the cases before, that offer does not contain any of the entry. So you'll pass the entry of received 4,000 share applications. So what will be the entry? Bank debit, because the money is credited into the bank account of the company. So bank debit by 4,000 into 15, 60,000. And share application shall be credited by 4,000 into 15, 60,000. Then issued 4,000 shares at 15. Now we have to reduce the share application account because now the shares have been issued to the application holders. And when the shares are issued to the application holders, they have become the shareholders, their amount shall be credited with the share capital account. But in part 1 we discussed that share capital will always be credited by rupees 10. And here the shares are issued at 15, so the 5 rupees will be credited by share premium. So 4,000 into 10 into share capital and 4,000 into 5, 20,000 into share premium. Then we will write the entry of underwriting by the bank. So when bank purchases the remaining shares, it shall add some amount to the bank account of the company. So bank account will increase again and bank account shall be debited by 1,000 applications were purchased by the bank at the rupees 15. So 1,000 into 15, 15,000. And now the bank has become a shareholder. So we have discussed in part 1 that whosoever has become a shareholder, his amount shall be credited by share capital. And as the company has issued it more than the par value, rupees 15, so 5 rupees shall be in the share premium. So the entry shall be bank debit, share capital credit, and share premium credit. Now that's all for today's lecture. If you have any question regarding today's lecture, you can put your question into the comment section and that shall be answered into the next videos. Till then, good luck.